Welcome back to Explain the Charts, your go-to source for in-depth market analysis. Today, September 16, 2025, we're dissecting the USDJPY pair, looking at both the critical news driving its movements and the raw chart data telling its story. We have a massive week ahead with the Federal Reserve's interest rate decision on Wednesday, followed by the Bank of Japan's monetary policy announcement on Friday. These events are setting the stage for significant volatility, and understanding their potential impact is crucial. Starting with the broader market sentiment, the US dollar is currently underperforming, with expectations firming up for the Federal Reserve to begin its monetary easing campaign. The US dollar index, or DXY, is trading lower as traders have fully priced in an interest rate reduction by the Fed for its upcoming meeting. This widespread anticipation of Fed rate cuts is a primary driver of the current dollar weakness across various currency pairs. On the other side of the pair, the Bank of Japan is widely expected to maintain its dovish stance, keeping interest rates on hold at 0.5%. They are leaving the door open for future hikes, but this inaction, coupled with domestic political uncertainty in Japan, is undermining the safe haven appeal of the Japanese yen. This monetary policy divergence between the Fed and BoJ creates a complex backdrop for USDJPY. Additionally, we've seen some mixed economic data, with U.S. retail sales for August showing a better-than-expected increase of 0.6% from July, which could provide some counterpressure. However, concerns are rising that President Trump's tariffs might begin impacting the job market and contribute to price increases, adding another layer of uncertainty. Now, let's turn our attention to the daily chart to see how these fundamental drivers are reflected in price action. Looking at the daily candles from mid-2024 through today, we can observe a rather choppy but overall downward-sloping trend, especially after the peak seen earlier in the year. Notice the significant drops in mid-2024, particularly around July, where the pair fell sharply from highs near 161.50 down to the low 150s. This aligns with initial fears of trade wars and anticipated Federal Reserve rate cuts mentioned in some 2025 forecasts. However, those forecasts also predicted a bullish turnaround in the latter half of 2025, driven by a more hawkish Fed and BoJ inaction. While the broader trend has been downward, recent price action, particularly since August 2025, shows the pair attempting to consolidate. The current market overview from FX Street notes a sideways consolidative price move above 147.00, which is precisely what we're seeing play out around these recent candles. The price has repeatedly tested the 147.00 psychological level, finding support there on multiple occasions in late August and early September. The last full daily candle, closing on September 15th, finished right around 147.395, clearly holding above this crucial 147.00 mark. This 147.00 level now acts as a significant short-term support that bulls will defend vigorously. Conversely, we can identify immediate resistance around the 147.80 to 148.00 zone, which the price has struggled to break cleanly in the past few trading sessions. Transitioning to the 1-hour chart, please note that our available data for this time frame ends on September 1st, 2025, offering us a glimpse into the volatility around that period. This range, from late August to early September, captures a period where the dollar was actively experiencing weakness due to growing Fed rate cut expectations. We can see how aggressively the pair sold off, particularly on August 27th and 28th, reflecting the dollar falling across the board narrative from our news. The price swiftly moved from highs near 148.18 down to the 146.80 region within just a couple of trading days. This sharp move highlights the market's sensitivity to Fed expectations, causing quick bearish impulses in USDJPY. However, notice the rebound from the 146.80 level, where buyers stepped in, pushing the price back up towards 147.20 by September 1st. This indicates a strong support zone around 146.80 to 147.00, even during periods of significant dollar weakness. The rapid fluctuations within this short period underscore the importance of monitoring lower time frames for precise entry and exit points. Now, let's zoom into the most recent action on the 15-minute chart, covering September 15th, the last full trading day available to us. This granular view allows us to see the intraday dynamics that led to the daily candle's close. Starting the day, USDJPY opened around 147.67, but quickly faced selling pressure, dropping steadily throughout the early hours. We saw a clear downtrend with lower highs and lower lows, indicating strong bearish control during this specific period. The price broke below the 147.50 level, which Forex Crunch identified as a key short-term support for a bearish continuation. However, around the European and U.S. sessions, the selling pressure eased, and the pair found a strong bottom near 147.22. This 147.22 level, just above the 147.00 psychological mark, served as a reversal point for the day. From this low, we observed a steady recovery, with the price pushing back up to close around 147.395, erasing some of the earlier losses. The significant volume during the initial sell-off and then the subsequent recovery shows active participation from both bears and bulls. The fact that the price managed to recover and close above its intraday lows, but still below its open, suggests a tug-of-war is underway. So, what does all this mean for USDJPY's short and long-term outlook? For the short term, the immediate price action around 147.00 is critical. If the pair can hold above 147.00 and especially above the 147.20 to 147.22 area we observed on the 15-minute chart, a bullish reversal could be underway. The key resistance to watch on the upside is 147.54, as identified by FX Street, and then 147.80, which we've seen as a recent intraday ceiling. A break above 147.80 could signal a retest of the 149.00 resistance level, as also suggested by Forex Crunch. Reasons to be bullish include the Bank of Japan's continued dovish stance and the long-term uptrend predicted by some analysts for the latter half of 2025. On the bearish side, continued firm expectations of Fed rate cuts will keep the US dollar under pressure. If the pair breaks decisively below 147.00 and especially the 146.50 support, we could see a strong continuation of the bearish trend towards 139.73 and even lower. The poor August jobs report and capital flow trends away from the dollar would reinforce this bearish scenario. Traders should closely watch for price action around these key levels, particularly during the high-impact news events this week. Significant volume spikes accompanying breakouts or breakdowns from these levels would add conviction to the move. Let's recap the important price levels and our unbiased predictions for USDJPY. Immediate strong support lies around 147.00, reinforced by the 146.50 level below it. A sustained break below 146.50 is highly likely to trigger further declines, with an 80% probability if confirmed by strong bearish momentum and news. This move would be reinforced by a dovish Fed and continued dollar weakness, potentially targeting 139.73. On the upside, immediate resistance is found at 147.54, with a more significant hurdle around 148.00. A successful push above 148.00 could open the path to retest 149.00, with a 60% probability if the Fed's stance is less dovish than expected or BoJ surprises. This bullish move would be reinforced if the BoJ remains exceptionally dovish or if Japanese political instability deepens. Looking further out, FX Street forecasts stronger gains in the latter half of 2025, suggesting that dips could be buying opportunities if the long-term bullish trend truly materializes. However, based on our recent charts, that long-term uptrend has been challenged, so caution is advised. Key upcoming events include the Fed interest rate decision on Wednesday, U.S. retail sales data today, and the BoJ monetary policy announcement on Friday. Pay close attention to how the market reacts to these announcements, as they will provide the clearest signals for the next significant move. Always remember to manage your risk carefully and confirm moves with multiple indicators before making any trades. Thank you for joining us on Explain the Charts. Don't forget to like, subscribe, and hit the notification bell for more in-depth analysis.